Hi, everybody. This is Jack Alwell with another money episode. Today, we have Nate Dean, the infinite banking coach. He is at Chronicles Nate on Twitter with over 51,000 followers. Nate, welcome to the show. It's great to have you.
Oh, I appreciate it, brother. Thanks so much for having me.
So, Nate, before we get into the infinite banking concept, I'd like to ask all the guests, what was your relationship like with money growing up?
Well, my dad was a business owner. So I got to experience at an early age. He started his company when I was 8 years old. And he owned it up until the day that he passed away from cancer in 2012. So I got to experience firsthand what it's like to witness a business owner in action, and see the relationship that he had with money, and how he operated and everything like that. And uh, but the experience of watching him as a business owner was really insightful because it allowed me to see what it was like for someone to create something and build something and also control their time. So that was really important to me. Relationship with money. I went to school for business and finance. I ended up going to college and I just figured I would get a business degree and figure out what I was going to do with that. At one time, I figured I would just, take over the family business at some point. Um, and I was always just fascinated with causes and effects of markets and things like that. So economics, that was my favorite subject, was just studying markets and things like that. So, but in my working years, early in my working years, a lot of what I was following was just the traditional, conventional wisdom of, Dave Ramsey, basically just pay off all your debts and pay cash for everything. And I thought that was the absolute best way to operate in someone's financial life. And it took me a while, but eventually discovered that there's a lot more efficient ways to run your life when it comes to money.
Going back to your dad actually for a second, how would you characterize his relationship with money? You said he kind of, he controlled his time, but if you had to put it to words, how would you characterize his relationship to money?
We had, a decent, he made a decent living as a business owner. Now he never really scaled his business, and branched out and opened multiple locations and things like that. So in a town of 25,000, there's only so many people you can service and only so much foot traffic you can get. So, part of our story in 2003, I built a website for his company, and the website did really well for several years. I ran it full time. But in terms of his relationship with money, so much of what he was doing from day one was just reinvesting back into his business constantly. And so he paid himself, a very reasonable salary, and everything else was reinvested back into the company. And so I think there's a lesson there in just thinking long term, which is the number one principle we teach, where he saw the value in reinvesting back into his business and not necessarily just taking all the profits like some business owners do, unfortunately.
Cool. Okay, so now to pivot to the guts of the interview. Now you do say on Twitter that Dave Ramsey has blocked you. I'm kind of curious if Dave Ramsey was here, because he has helped a lot of people from mentality perspective getting out of debt. What would your
Yeah.
message be to Dave Ramsey if he was here right now?
I would say thank you, because he's been a gift to a lot of people when it comes to building financial discipline in their life. And there's some people that, until they have financial discipline, they're not going to be ready for any sort of additional strategies. They're not going to understand how to leverage money properly and things like that. So he's been a blessing to a lot of people, and he was a blessing to me as well. But it just finally got to a point in my life where having the financial discipline, eventually you get to a point where you're thinking, okay, now I'm disciplined. Now what do I do? And the one thing that I don't understand about what Dave teaches is he's very risk averse. He's always teaching people to get out of debt and avoid debt at all costs. He doesn't teach that there's good debt and bad debt. Every bit of debt he talks about is bad debt. So he's very risk averse, but then he points people back to growth stock mutual funds, which are extremely risky. And I heard someone say, it may have been Jack Bogle, but it was somebody in the industry said that only a crazy person would put money into mutual funds when they understand that they take 100% of the risk, but only get about 30% of the profit.
Okay. So how did you get introduced to the infinite banking concept?
So back in 2017, me and my business partner, we have known each other for a long time, 30 years this year. And so we grew up together, junior high and high school. Our families were friends. We went to church together, all that stuff. And, after high school, so many times life just kind of takes you different directions. So that's kind of what happened to us. And we reconnected. And in 2017, we just started holding each other accountable in so many different areas of our lives. We're strong believers in Christ, and that's something we don't shy away from as far as our faith goes. So that's something that was really important to us. And also just being better husbands and fathers, and making sure we were taking care of our bodies, training, getting stronger and healthier and everything like that. So there's so many different aspects of what we were doing from the accountability perspective. And I came in the midst of our accountability, I came across the book, Becoming Your Own Banker, which is right here in the corner of my office, written by Nelson Nash, and read that book. And immediately, with all my Dave Ramsey background, I knew Dave was not going to be a fan of Becoming Your Own Banker. And Brandon also had a hardcore Dave Ramsey background. So I shared the book with him. I said, I read this book. It kind of twisted my mind a little bit, and I need you to read it and give me your perspective on it. So he had a similar experience after reading the book. He was like, eventually he came back and he's like, man, if this is real, this is crazy. And I was like, yeah, that's kind of what I thought too. So we started doing some research, found out that people really were actually using this and having success with it. And the next step for us was, all right, who do we talk to about this? Like, how do we actually get started? And so we found a podcast. These two guys in Kansas, Mike and Chris, their podcast was just devoted to infinite banking. That's all they did in their practice, was teach people about infinite banking. And combined, they had about 15, 20 years experience. So we were really drawn to their conversation. They were very matter of fact in the concept. They weren't trying to hype it up, make it something that it wasn't. So we ended up reaching out to them and started working with them. They helped us get our strategy set up. But we became so inspired by all the things that they had taught us that me and Brandon one day were just like, man, wouldn't it be cool to go teach other people how to do this? And so we reached out to Mike and Chris and told them that we've just been inspired by what they had taught us, and they agreed to mentor us, and they just poured into us for a couple of years as we were building our business. And then eventually one day we had a conversation where they said, hey, we're kicking y'all out of the nest. We can't teach you anything else. Y'all got this, just go out and make us proud. And so we still have an incredible relationship with them, and their full names, Mike Everett and Chris Bay, because I want to make sure people know exactly who they are. They are the owners of Life Success and Legacy is the name of their business.
Okay.
And so we've modeled a lot of.
Podcast called?
It's called Life Success and Legacy as well.
Okay. Gotcha.
And so we have modeled a lot of our business from what they taught us and the process that they took us through in working with clients. So we owe them an incredible debt of gratitude for sure.
So I know it might be hard to describe without a spreadsheet and the numbers in front, but for someone that's never heard of the infinite banking concept, can you try to describe the mechanics of it?
Sure. So Nelson Nash figured out many, many years ago through pain and struggle and trials and all these things in the 80s, he figured out that a dividend paying whole life insurance had more value to someone's life than what he had been taught. And it was something that he just discovered. And what he found out is that we can actually create our own private banking system inside of a dividend paying whole life insurance policy. Now, to simplify that, what we are effectively doing is we are establishing an ever increasing line of credit inside of one of these policies that we own and control, that can earn interest even when we're using it in other places to create value simultaneously. So what it gives you the ability to do is do multiple things with a single dollar. Where most people are just getting one use out of your dollar, we show you how to get multiple uses out of a dollar.
Can you describe a little bit of because a lot of people say, well, there's got to be risks. And so the crediting mechanism inside the whole life policy, like how you're able to borrow against it, and why, if you borrow against your stocks, well, your stock can go down. And if you borrow against your house, the house value can go down. So what is the crediting mechanism in the whole life policy?
So a whole life insurance policy is an asset. Now, it's a forgotten asset class because in the 60s and 70s, when the stock market started getting really sexy for people started diverting money away from whole life insurance and started putting it into stocks. And also there was this guy that came along named A.L. Williams that started convincing a whole lot of people that they needed to buy term insurance and invest the rest into the stock market. And he had interest in both of those endeavors, on selling insurance and also managing mutual funds. So it was a win-win for him, for people he came across, to get them to get out of their whole life insurance policies and redirect those funds. So whole life insurance is an asset, and it's very closely tied to real estate, because in real estate, you've got the market value of a piece of property. In whole life insurance, you have the death benefit, which is the value of the policy. Now, as we're paying in real estate, as we're making payments as we're like, if it was just a house or something like that, if we're making mortgage payments, we're building equity inside of that property. Equity is just the portion of the asset that we actually control at that point based on what we've put into it. Your whole life insurance policy, as you're paying premiums, those premiums are creating cash value, which is the equity inside of your policy. So you have a contractual rate of growth on a whole life insurance policy. The insurance company guarantees to pay by contract no matter what. And these insurance companies that we work with have 115, 120-year track record of profitability. So through depressions, recessions, you name it, they've posted profits and paid dividends to their customers the entire time. And anytime you're looking at something like this, you want to work with a company that has at least a 100-year track record of profitability. So by contract, your cash value has a contractual rate of compounding growth that takes place throughout the year. And then on top of that, when the profitability is, or when the dividend is declared at the beginning of the year, they are promising that to the customer at the end of the policy period. So at the end of the policy period, which is a 12-month period, they pay out a separate dividend on top of the contractual rate of growth on the policy. So your principal cash value has a compounding growth effect on it, where when you're taking out loans or collateralized loans against your cash value or your equity, that is a simple interest loan that you're creating. So what happens over time is you end up creating net positive outcomes with every policy loan you take out, because by the time you repay your system, it's worth more than when you originally took it out. Now, that idea of loans can hang people up. So let me explain one of the key principles you must understand with infinite banking, and really with life, and how you operate with money. You finance everything in your life, whether you're paying cash for it or not. That is a profound statement that most people don't understand. So I'm going to break it down and make sure you understand. So it's twofold. So on one hand, we're always giving up interest. So when we're borrowing from a bank, we're obviously giving up interest. We don't have the ability to earn interest on money that we borrowed because we're paying interest in that situation. But when we are saving up and paying cash for something, we are giving up the interest that money could have earned if it would have been in a better environment. So now the other side of that is you're always making payments to someone. When you're borrowing from someone, you're making payments to the bank. When you're paying cash for something, you're making payments to yourself, either systematically or sporadically. You're making payments to yourself for a future purchase. So if you can understand those concepts and see how that applies to the infinite banking concept and how we understand how money has to flow no matter what, it can be really powerful for someone.
Awesome. So knowing that information, how can you give us like a little picture of how someone could eliminate debt using a policy? Show
Sure.
Dave Ramsey something.
So, well, this is actually my own story. So I have a ministry background. I've done youth ministry, music ministry, even pastored a church. And so, at the time that I learned about infinite banking, I wasn't making a whole lot. My wife was a high school educator. You know, we never really had a whole lot. During those years, we got started with what we could start with. At the time, we had some credit card debt that we were paying off, which, you know, average credit card interest is probably 15, 20%, something like that. So we had this headwind that we were fighting when it came to the amount of interest that we were being charged, while simultaneously we had money that was, ironically, we had money in mutual funds, because that's what Dave told us to do. So we had money in mutual funds that were doing well, but they weren't creating any value for us whatsoever in our present situation. That was all accumulated value for the future. But what we needed was something to shift the wind current, is what we like to call it, where we turn that headwind of interest that we were fighting against at 15 to 20%, where we may have had mutual funds that were growing at 10 to 12%. We could take those mutual funds, because 10 to 12% is not greater than 15 to 20%. So, and that's what the average person is doing. They're saving money, but then they're fighting this invisible headwind of interest, and they don't realize they're never going to get where they think they're going to go. So what Mike and Chris showed us was, hey, you can reallocate or reconfigure the use of these dollars that are in the market right now, and actually inject them into your current situation, flip the scale, so to speak, or tip the scale, so to speak, where instead of having this outside debt where you're making payments to another institution, now we created a debt inside of our policy where now we're making the payments back to ourselves. So what we did is we turned a guaranteed cost that was going out the door every month to us. We turned it into guaranteed cash flow that's now going back to fund our banking system. And that was all done through the policy and understanding how to actually borrow against your equity in your policy to eliminate debt. Because when you're borrowing from your banking system, what you are effectively doing is you're refinancing that debt away from the bank, where the bank controls the terms, the bank's benefiting from the interest, and then you're bringing that into your own banking system to where now you control the terms, and ultimately you get to benefit from the interest.
So if you were to take a loan, could you just give the listeners a sense, the actual loan is not coming out like when they say, you know, you're borrowing your own money, it's really not, it's a loan with the policy as collateral, and the money's coming out of, I believe, the general account. Can you kind of make that distinction to help people?
Sure. So the insurance company, by contract, you have two different options for how you can access your equity in your policy. You can just take a straight cash withdrawal from the policy in terms of your cash value, your equity. You can remove that completely, but then that disrupts the growth of your principal account values. So a better option is to understand how to properly apply the principle of leverage in your life using a policy loan, so that you keep pressure on your principal cash value to grow uninterrupted the rest of your life. And so what the insurance company allows you to do is they'll let your money sit in the policy, your cash value sit in the policy, and you can request a loan by contract. You can request a loan based on the cash value you have available. And they will pull that from their general fund, and they will send you that money. And no one can borrow money for free. So there's always going to be a cost to capital. And this is something else that gets misunderstood sometimes with this is they're like, you're paying interest on your own money. But remember, we're always paying interest. We're either paying interest or we're giving up interest. So if we can take control of that entire equation so that we give ourselves the ability to recover opportunity cost, which is the interest that would have been earned if our money would have been in a better environment. Now, like I said earlier, we start to create net positive outcomes with the money that is going out. So that as the money returns, and remember, money has to flow no matter what. So as the money returns, it returns bigger than when it originally left, so to speak, because of that constant growth factor on our dollars. And so that's something that, again, is often misunderstood, that there is a loan rate. But let me give you an example of kind of how the loan rate works. So let's say you had $10,000 cash value in your policy and you wanted a max policy loan. So the insurance company is going to subtract, it's prepaid interest. So they're going to subtract whatever the loan rate is. Let's say it's 5%. So they're going to subtract 500. They're going to send you 9,500. Now, if you pay that loan off in 6 months, as an example, they're going to credit half of that interest back to you. Now, the other half would have gone to the insurance company. But the reason that doesn't matter to me personally is because as a customer of the company, I get to participate in the profitability of the company through dividends and long-term growth. So as long as I'm being a good banker and as long as I'm continuing to allocate funds towards my banking system, then I'm not worried about any amount of interest that I'm paying, because in all likelihood, I'm creating far more value for myself outside of putting those dollars to work in my life somewhere than any amount of interest that they're going to be charging me. Now, that's how the interest works. What you also have to remember is your principal cash value is growing uninterrupted the entire time. So with that constant pressure on those dollars to grow, you continue to close the gap more and more on the cost of capital, where eventually you get on the other side, you get on the positive side of the interest altogether, to where now, this is going to sound crazy, but your expenses can actually earn you interest. You can actually make money off of your expenses, which is a wild concept, because most people only know how to make interest off the money that's saved, not the money that's spent.
How about the startup costs? Because, there's no free lunch. So what are the costs to start up, your banking system?
Okay, so first, there's no other asset class out there that fully compares to infinite banking. Now, infinite banking is a process. It's not a product. It just so happens that dividend paying whole life insurance is the most optimal asset class for this whole process to become your own banker. So infinite banking is a process, but the product of whole life insurance and, let's say, a Roth IRA, if we were to compare those two together, the line of thinking when someone's funding a Roth IRA, like if you went to 100 people right now and said you need to be putting money in your Roth IRA, 100 of them are going to go, I'm either doing it already, or you're right, I should start doing that. Nobody's going to argue with you. Nobody's going to say, why would I do that? That's crazy. Okay. Now, when somebody is funding a Roth IRA, they're not thinking, I'm going to use some of this money next month or next year. They're thinking 20, 30, 40 years down the road. Okay. Now, the number one principle in the infinite banking concept, Nelson's number one principle, is you got to be willing to think long term. So if you're funding a Roth IRA, you're already thinking long term. So you've already got that piece down. Okay. Now, this is a life insurance policy. So there is a cost for the death benefit. There's a portion of your premiums that are going into the policy that are satisfying the death benefit. So the way the policy is structured and designed is to make sure that you have a sufficient amount of death benefit, but also you have a sufficient amount of cash value that you can actually use to your advantage. But your cost of insurance is going to be the upfront cost, so to speak. Now, the way The way we would typically design a policy, just to help somebody understand, is if you had $10,000 to get started and you were doing like a lump sum annual premium, you might have 30 to 40% of that that's allocated towards the death benefit portion of the policy in the first year, and 60 to 70% of that that's allocated towards the cash value portion of the policy in the first year. Now, your base premium that goes towards the death benefit doesn't start producing cash value until year 2. Once you get into your second year, then you have more and more access to the dollars that you're putting in your policy. And typically by year 4, year 5, you got 100% access to all your premiums that you're putting in going forward. So there is a time horizon that can be uncomfortable for some people, but that's because most people aren't willing to think long term. And if you are willing to think long term, this can work out really well for you. The reality is most people are thinking long term or practicing long term thinking either by force through their 401k, because they're funding their 401k, or voluntarily by funding things on their own. So there's a good portion of people who are thinking long term, but it's almost on autopilot because they've never actually thought through that process of what they're actually doing. They're just doing what everybody else is doing. And infinite banking is doing the opposite of what everybody else is doing.
Yeah, I feel like the listeners can like rewind like a couple minutes and keep listening to that over and over. That was great. So this sounds great. In your opinion, what types of people shouldn't do this process?
If you are just paycheck to paycheck and you have no access to resources or anything like that, then I would say you need a certain amount of separation between your expenses and your income monthly. Now, we recommend at least $500 a month in disposable income because we never want to put someone in a position where they're not going to be successful with their strategy. And we feel like if you've got $500 a month in disposable income, then you've built a little bit of cushion for yourself that you can eventually expand on. So we do have clients who put $500 a month into their policy. And we also have clients who put 6 figures a year into their policy. So everybody's a little bit different. And I think that's one of the cool things about infinite banking is it's a strategy that the average, middle-class person can participate in and be a part of and be successful with. But it's also a strategy that, we have millionaire clients that we work with that are successful with it as well.
I found out recently the number one owner of these policies is actually the banks. So Nate, why are the banks purchasing these policies?
So this goes back to something I said earlier, which is whole life insurance is a forgotten asset class. And most people don't even realize it's an asset in and of itself, but it is so highly ranked in terms of stability that a bank lists a whole life insurance policy or their whole life insurance as their tier 1 asset class, which is the most stable asset class they can list on their balance sheet. So the reason why banks participate in whole life insurance is because of the stability of it and the flexibility of it. Because one thing that I haven't said yet is when you take a policy loan from your cash value against your cash value, you get to control the terms as far as when and how you repay your loan. So it's a brilliant strategy for business owners because business owners need flexibility because we have cyclical, times in our business where things are really good or things slow down a little bit. And having that flexibility can be really powerful. We practice this personally, but we also practice it in our business. We have multiple policies inside of our business that we're running our revenue through each month.
And what about people that might have a pre-existing illness and going through underwriting might not really look all that appealing to them? What are their options?
So for someone who is uninsurable or thinks they're uninsurable, I would not necessarily just write off the ability to practice the concept, because most people have insurable interest in someone else in their life. If you have depending on age, and eligibility and all that stuff, if you have a parent, if you have a sibling, if you have a child, if you have a business partner, if you have a spouse, you have some level of insurable interest in that individual, which means the insurance company will look at the relationship that you have with that individual, and you can make a case to the insurance company that says, if this person were to die, this is the financial responsibility I would have to take on. So I was speaking with a couple just yesterday, and she said, hey, I've been talking to my sister about this. She's really interested, but she is not insurable. And I said, okay, does she have parents? Does she have children? And she's like, yeah. And I said, okay, well, she's your sister. So if something happens to her and her husband, who steps in and takes care of the nieces and nephews? And she said, well, that would be us. And I said, well, she has insurable interest in you then. And she was like, wow, that's really cool. So just because someone can't get insurance on themselves doesn't mean that they can't practice the concept.
Awesome. Great. Well, as we're winding down, I like to ask everyone, what is the best and worst personal finance advice you've either heard or received?
I can't say it's the worst, but just straight up paying cash for things is not near as efficient as people realize it is. There's so much better things that you can do once you understand how to properly apply the principle of leverage. Leverage is the key to wealth. Like every successful person in life has applied the principle of leverage at somewhere along the way in their life. And so the worst advice I would say when it comes to, the absolute worst advice is, hey, live off credit cards, but that's a given. The little known worst advice would be pay cash for everything the rest of your life. Because you're going to be leaking opportunity cost out of your life forever if you do that. And if you figure out a way to create a system that recovers opportunity costs, you're going to end up scooping up dollars that were leaking out of your life that you didn't even know they existed. You didn't even know that those dollars were leaving. But when you are able to start plugging the holes, so to speak, in those leaks, it's amazing how fast your money starts to grow. And when you can create those net positive outcomes for yourself, for not only the things you invest in, but also the things that you're spending money on simultaneously, uninterrupted growth on your money can be extremely powerful. So paying cash is inefficient. There's definitely better ways you can do that. The best advice I could tell anybody is understand the principle of leverage and how it can be applied in your life. Leverage does not always equal risk. And that's one of the things that people shy away from when they hear the word leverage. They automatically associate it with risk. But when you understand how to control the equation, build the environment and control the equation, leverage can be extremely powerful.
Awesome. Well said. Well, Nate, I've really enjoyed talking with you. Why don't you tell the listeners where they can go to learn more about you and your services?
Okay. Well, we built our business on Twitter. As you said earlier, the best place you can find me is at Chronicles Nate on Twitter. I'm Nate, the Infinite Banking Coach. Our website is unlimitedlifeconcepts.com. If you go to our website, unlimitedlifeconcepts.com/course, you can actually check out our educational course that we created for infinite banking. It's a series of videos. They're 3 to 5 minutes a piece. The course comes with several different things. First off, it's $49. It's a one-time $49. But you get access to all the videos we created. You get a physical copy of Become Your Own Banker. We ship out to your door. And you also get access to our team. We'll do one-on-one coaching with you. That's all included in the course. If you go through our process and you see the value in infinite banking and you want to work with us, then at that point, we will come alongside you as your coaches, as well as your agents, and write the policy, get it set up for you. But for your listeners, I want to give you a little secret, which is if you go to unlimitedlifeconcepts.com/course and you use the promo code Nelson Nash, all one word, it will automatically give you 50% off on the course, which is a little less than $25. If you tried to buy Nelson's book off Amazon, it would cost you about 25 bucks. So for 25 bucks, you get the book, you get all our videos, and you get access to our team.
Wow. Awesome. I mean, I gotta say, I have the book right here. It's definitely changed my life. It is clear, very much a game changer. And Nate, I've really enjoyed having you on, and I think the listener are going to get a lot of value out of this. So thanks so much.
Well, thank you so much for having me. I appreciate it.